Hello, and welcome back to Explain the Charts, your go-to channel for in-depth technical analysis. Today is October 2nd, 2025, and we are diving deep into the QQQ, the ETF that tracks the Nasdaq 100. First, we'll cover the major news and macroeconomic factors shaking the markets, and then we'll jump into the charts to see what the price action is telling us. The big headline this week is that the broader market, including the S&P 500 and the Dow, has been hitting new record highs, with the Nasdaq itself hovering just below its own recent peak. Interestingly, Wall Street seems to be completely shrugging off the recent U.S. government shutdown, suggesting that this event was largely anticipated and already priced into the market. The real market mover was yesterday's weaker-than-expected private sector jobs data from the ADP report. This report showed a surprising loss in private jobs for September, which has significantly shifted investor sentiment. In response, the market is now pricing in a near 100% probability of an interest rate cut from the Federal Reserve later this month. This renewed optimism for cheaper capital has traders rotating back into risk-on assets and growth stocks, which is typically very bullish for the tech-heavy Nasdaq. However, there is a counter-argument to consider. Some analysts, like Jonas Galterman of Capital Economics, are pointing out that a softening labor market could be a long-term headwind, posing downside risks for equities down the line if it signals a weakening economy. We also have the busiest part of the earnings season coming up, with giants like Meta, Microsoft, and Apple all scheduled to report, which is guaranteed to bring volatility. So we have a classic battle between short-term bullishness from potential rate cuts and long-term bearishness from a potentially slowing economy. Now, let's bring up the daily chart for QQQ to see how this all translates into price. Looking at the big picture, we can see a very strong and sustained uptrend since the sharp sell-off we experienced back in early April of this year. The market has consistently bought the dips, pushing the index to new all-time highs. The most recent all-time high was set just yesterday, October 1st, where the price touched $603.79 before closing slightly lower at $603.25. This all-time high area around $603 is now our immediate and most critical resistance level to watch. A decisive break and hold above this level would signal a continuation of the powerful uptrend. On the downside, our first key area of support is the previous record high set back on September 22nd, right around the $602 level. Below that, a more significant support zone lies around the $590 to $591 area, which was resistance in mid-September before the latest leg up. Should we see a more serious correction, the next major support level to watch would be the highs from late August, right around $575 to $580. It's worth remembering how volatile this market can be, so let's quickly zoom in on the action from this past spring. If we focus on the period from March to late April 2025, you can see the dramatic sell-off we had. The price plunged from around $540 all the way down to a low of nearly $402 in a matter of weeks. But look at the recovery. It was an incredibly sharp, V-shaped reversal, demonstrating immense buying pressure and investor appetite for tech stocks. This shows that traders have been conditioned to buy dips aggressively, a factor that could provide support in any future downturn. Okay, let's switch to the hourly chart to get a better look at the most recent price action. Here we can see the powerful move up that began on September 25th, taking us from around $592 to yesterday's all-time high. Yesterday's surge was clearly driven by that weak jobs report and the subsequent rate cut hopes. Since hitting that peak, the price has entered a period of consolidation, trading mostly sideways in a tight range between roughly $596 and the $603 high. This type of consolidation after a strong upward thrust is often a bullish continuation pattern, like a bull flag. Traders are essentially taking a breather, digesting the news before deciding on the next move. A breakout above the top of this range at $603 would be a strong short-term buy signal. Conversely, A break below the range's support around $596 could signal some profit-taking and lead to a retest of that more significant $590 to $591 support level we identified on the daily chart. For an even closer look, let's jump to the 15-minute chart for the past 2 days. Here you can clearly see the market's reaction yesterday morning, October 1st. Following the jobs data, we saw an explosive move from a pre-market level of around $597 straight up to over $603 within the first couple of hours of trading. The volume during this spike was significant, confirming the buying interest. After that initial burst, notice how the price action became much choppier and moved sideways, with volume tapering off. This confirms the consolidation pattern we saw on the hourly chart. The market is currently in a state of equilibrium, waiting for a new catalyst to dictate direction. Alright, let's go back to the daily chart to recap and talk about potential scenarios. To summarize, the key price levels to watch are critical. Our primary resistance is the all-time high zone around $603. Our first support is the bottom of the current consolidation range near $596. Below that, major support sits at $590, followed by the $575 area. So, what are the likely outcomes? The bullish scenario, which I believe has about a 65% probability, is that the optimism surrounding rate cuts continues to dominate. In this case, we would see the QQQ break decisively above the $603 resistance, likely on strong volume, signaling the next leg up. Positive surprises during the upcoming earnings season would act as a powerful catalyst for this move. The bearish scenario, with about a 35% probability, would see the market's focus shift from rate cuts to the weakening economy that the job numbers might be signaling. If this happens, the price could fail at the $603 resistance and break below the $596 support. A failure to hold the $590 level would be a significant warning sign and could open the door for a deeper correction towards $575. This outcome would be reinforced by disappointing earnings reports or weak forward guidance from key tech companies. The main things to watch for upcoming inflation and employment data, and of course, those big tech earnings reports. These events will be the primary drivers of the market's next major move. As always, please remember that this video is for educational purposes only and is not financial advice. You should always conduct your own research and due diligence before making any investment decisions.